Hello students, welcome to the class. Today we will be doing MCQ of Management Accounting. So we'll start with the model question paper. Then subsequently we'll also take previous question paper. So MCQ is a section where you have to focus on timing. So you have 15 marks, 15 question, 30 mark, and the time available budgeted for this should be less than 30 minutes. And out of 15, at least you should aim to score more than 10. That means 20 mark you can get easily. Remaining 20-30 marks you can score with a combination of theory and problems. And there are two types of question. One is theoretical, either you know, or there are small problems. So for theory questions, you should take less than 1 minute. And for numerical, 2 minutes. Generally, the numerical problem you will be able to solve in 2 minutes. Some very rare, once in 3 years, they can give a slightly complicated, which may take 4 or 5 minutes. But typically what I've observed is 2 minutes is adequate if you practice well. So let us start. First question, which of the following is not a characteristic of management accounting? So in certain cases, if you do not know straightforward, what you should do is a mix of elimination. So here the question is not a characteristic. So decision making is a characteristic, so we will eliminate this. Then forward looking means you will be doing a lot of forecast and budgeting, so this is also eliminated. Then remains only two of them. One is historical orientation and second is internal focus. Why this is given? Because financial accounting is external focused, means the document you produce is for the external world. Management accounting is for internal. So this also is eliminated. So the answer is historical orientation. Second question, the break-even point is where? Try. So the first question, the answer for this is the first option. Total cost is equal to total revenue. That means your profit is 0. So this is fulfilling that condition. Third one, variance analysis is used to. So the answer should be identify root causes of inefficiencies. Why? Because there are a lot of variances you will get like price variance, usage variance. According to that, you can identify where is the inefficiency, whether it is with production department or purchase department. You can identify that. So A is the correct answer. Good. Which of the following is not a relevant cost information in a make or buy decision in short term? So not a relevant cost information in a make or buy decision. So option A, burglary means theft. So according to me also, so these are different type of insurance: fire insurance, marine insurance, burglary insurance. It is there. So in make or buy decision, which is not a relevant cost information, according to me, it can be fire. So your burglary information is basically for a product. Marine is also for a product. Fire is basically for a bigger stockpile of inventory. So in marginal costing, since we go with the product and fixed cost is not relevant, so the fire is not a relevant cost information. Reason, it is a fixed expense. These are all variable expense. That is my take on it. Next, if sales is equal to 9 lakh, margin of safety is 40%, PV ratio is 2/3, then what is the break-even sales? Now the formula you should use for this is margin of safety is equal to sales minus break-even sales. What they are asking is break-even sales. So margin of safety is 40% of sales. That means 9 into 40%. So 3.6 lakh is equal to 9 lakh minus break even. So therefore break even is going to be 9 lakh minus 3.6 lakh is equal to 5.4 lakh. So correct answer is C. Here you need not use your PV ratio at all. Sometimes that information is given, but you have to focus on what is asked. So next question. Sale for 2 consecutive months of a company are 3.8 lakh and 4.2 lakh. The company's net profit for these months amount to 24,000 and 40,000 respectively. There is no change in contribution sales ratio or fixed cost. The contribution sales ratio of the company is. So which formula you should use here? So the formula is PVR is equal to change in profit divided by change in sales. So among these, the 40% corresponds to 2 by 5. So this is the correct answer. In this question, they can also give in terms of profit, right? In one of the period, they can give a loss. So let's say this was the loss of 24,000. Then your numerator is the change of these two. So 40 plus 24, it will become 64. Okay, next question. Standard cost is a dash cost. So this is straightforward. This is predetermined. The definition of standard cost only is predetermined cost. Which of the following budgets should be prepared first? So answer for this is sales budget. And the process is easy to remember. First is budget with key factor. Key factor is what is the limitation. So it can be raw material availability or sales demand. With this comes your sales budget. Once sales budget is done, you have your production budget. Once you have production budget, you have all your functional budget. Means purchase, overhead, all these budgets. And all of these are going to be a master budget. So if you know this workflow, this question any type they can ask, you will be able to answer. Next question. Labor turnover dash. So the correct answer is rate of change of labor force. How many people got changed? So it can be addition, it can be subtraction, it can be flux method or replacement method. All of them are measuring rate of change of labor force. Next question, 10th. The per unit expense of the dash portion varies with the volume of production, while portion remains the same with volume. I think there should be a dash also here also. Dash portion varies with volume of production, dash portion remains with volume per unit. This is actually tricky. You have to look it through this graphical method. So on x-axis you have volume, on y-axis you have cost. Your fixed cost is of the nature, it's like this, and your variable cost is like this. So this is fixed cost, this is variable cost. In total, if they had asked, then B would be the correct answer. Variable portion varies with volume of production, fixed portion remains the same. But when it is per unit, absorption is per unit, variable cost will not change. So what remains same with the volume is variable. Then what remains, what changes is fixed. Per unit fixed cost changes. Why? Let's say you have 1000 as fixed cost. If you produce 1000 units, this is 1 per unit. But if you produce 500 unit, it becomes 2 per unit. So this behavior, it is changing. Per unit it is changing. So fixed portion varies with volume of production per unit, and variable remains same with volume. So correct answer is A. Which method of costing is commonly used by companies that produce unique products or services? So basically this is job costing. Job costing means it is customized. So customized means unique product or service. Material price variance is calculated by. So this is price variance. So the variance is because of price. What is the variance of price? SP minus AP multiplied by actual quantity. If you expand this, you will get SP AQ minus AP AQ. So option A is that. Next one. Calculate the material price variance from the following. AQ 2.5 kg, then SP is 3 kg, AP is 5 per kg, SQ is 4.5 kg. So this is very easy question. The formula, if you have got the correct in the previous question, you will solve this. So they have asked material price variance is equal to AQ into SPE minus AP. AQ is 2.5, SP minus AP minus 2. So it is 5 adverse. So B is 5 adverse, correct answer. Next, 14th. Which budgeting technique involves preparing budgets from the bottom of the organization hierarchy to the top? So this is straightforward, bottom up budgeting. Last one. A manufacturing company budgets to produce 10,000 units during a period. It expects to incur 50,000 in fixed overhead and 3 per unit in variable overhead. If the actual production turns out to be 9,500 units, what is company's flexible budget overhead cost? So answer is D, 78,500. Let's break it down. Variable overhead, you will get 9,500 into 3, 28,500, and fixed overhead is 50,000. So total is 78,500. Very easy question. So let's continue with another set of question paper. First one. In the context of budgeting, what is flexible budgeting? Yeah, the definition of flexible budget is it adjusts to change in activity level, whether it is 50% or 90%. Next question. Which of the following methods is used to allocate overhead cost based on the activities that consume resource? Straightforward, activity-based costing. Third one. In budgeting, what does a master budget encompass? Yes. So if you know the workflow as explained earlier, you can easily answer. It's a comprehensive set of budgets, including sales, production, and cash budgets. Fourth one. Marginal costing is also known as. Correct. So answer is D, all of A, B, and C. It is called using all these names. Fifth one. Fixed cost is 2.8 lakh, sales is 10 lakh, PV ratio 30%, calculate the amount of profit. So S minus variable cost is equal to contribution minus fixed cost is equal to profit. So sales is 10 lakh. PV ratio is given, so contribution is 30% of 10 lakh, which is 3 lakh. Fixed cost is 2.8 lakh. So profit is 20,000. So option D. Next one, calculate the material price variance from the following. Material price variance is given by AQ into SP minus AP. AQ is 3.5, SP minus AP is equal to minus 4. So this is 14 adverse. Let's check the option. So option B is 14 adverse. Seventh one, in the context of cost accounting, what does the term relevant cost refer to? Basically, they're asking relevant cost definition. Correct answer is option B. Relevant cost means it has input in decision making and also it is affected by the decision. So that is relevant cost. So question number 8. A company has a net profit margin of 0.25. Total asset turnover is 1.6 times and equity multiplier is 2.5. Calculate return on equity as per DuPont analysis. As per DuPont analysis, return on equity is given by 3 factors. First one is net profit margin. Second one is asset turnover. Third one is financial leverage. Financial leverage is also called as equity multiplier. So net profit margin is 0.25, asset turnover is 1.6 and equity multiplier is 2.5. So return on equity is 1. If the same question is asked as a 7-mark question, you will have to calculate this individually. Here it is given directly, but there you will have to remember what is net profit margin, what is asset turnover, what is financial leverage. Next question. During September, 400 labor hours were worked for a total cost of 8800. The variable overhead expenditure was 800 adverse. Then overhead are assumed to be related to direct labor hours of activity working. What was the standard cost per labor hour? So what is asked here? SR is asked. So since the overhead expenditure, variable overhead expenditure is asked, the formula for that is actual hour. So variable overhead expenditure variance is equivalent to your labor rate variance. So if you remember labor rate variance, variable expenditure variance also is the same. Actual hour into standard rate minus actual rate. So this is your labor rate variance or variable overhead expense variance. Here labor overhead expense variance is given, which is 800 adverse. So we will write minus is equal to AH is 400 actual hours. SR you don't know, you have to calculate that, minus AR. AR also you don't know, but 8800 is a factor of AH into AR. So when you expand this, this will become 400 SR minus 8800. Now you have to solve for this. So 8800 goes on the left side, it becomes positive, minus 800 is 8000 is equal to 400 SR. So therefore SR is 20. Next, question number 10. Responsibility accounting primarily measures which two aspects of responsibility centers? So this is actually a tricky question. If you know responsibility accounting, you can easily answer this. The correct answer is B. Revenue and sales are the types of responsibility centers, or cost and expenses is a type of responsibility center. But exactly what they do, whatever is the budgeted and actual result of that center. If it is a cost center, then budgeted cost and actual cost. If it is a revenue center, it's a budgeted revenue and actual sales. So it is budget and actual result. 11th one. A strategy that yields an expected monetary payoff of 0 is called. So let's try doing an elimination. If you do not know, then you'll have to eliminate to improve your chances of getting the correct answer. It cannot be a zero-sum game. Zero-sum game does not come under the concept of expected monetary payoff. This is part of your decision theory, last chapter. Then risk neutral strategy also, it is not part of your decision theory. There is a certainty equivalent and a fair game. Okay. But in the certainty equivalent, definitely the payoff is not 0. Your payoff, you know exactly how much you are going to get. Hence, this is also not a correct answer. So the answer can be B. So 12th question. According to Kaplan and Norton, which of the balanced scorecard perspective serves as the focus of other perspective? So balanced scorecard, how to remember? LIC finance. L means learning, I means internal processes, then C for customer focus, F for financial performance. So what is the question is being asked? Which of the balancing serves as the focus of other perspective? Means out of these 4, the remaining 3 focuses on one of the perspective. Means the output is related to one of the perspective. Financial is the answer, because you are doing all other so that your financial results improve. 13th. Which of the following would be considered an operating asset in return on investment computation? ROI. So ROI is equal to what? Your return divided by investment. So this investment is, now they are asking based on operating asset. So which of the following can be an operating asset? So land being held for plant expansion is a fixed asset. Treasury stock is a fixed investment. Common stock, in operating asset, common stock or the inventory is taken out. So account receivable is the correct answer. What is the primary function of KPI in the role of management accountant? The answer is implementing cost reduction strategy. Monitoring compliance is part of your audit. Assessing organizational performance you will do through your financial statement, your ratio analysis. KPI, why do you do? You have to assess the performance of individual cost centers, then cost reduction strategies. Then conducting variance analysis is part of your standard costing. So correct answer is C. In a decentralized organization, what role does responsibility accounting play? You can try eliminating this if you are not, very, 100% this is the answer. So these three options can be eliminated. That means answer is A. So another set of model question paper. Creation of value through effective use of resource is the focus area of. So there are different stages of your business. First, second, third and fourth stage. So there is from 15th century to current, and they are divided into different stages. Out of that, the effective use of resources comes in which stage? So it comes in the fourth stage. Which personnel of a financial firm play a key role in management accounting? Very easy. Managers. Third one. Activity based cost system would probably provide the greatest benefit for organizations that use. So wherever there are different activity, it is giving great benefit. That is the basis of activity based costing. Among these types, the more number of activity or different types of activity are found in job order costing, jobs. Fourth question. Determine sales in rupees for desired profit. If fixed cost is 10,000, variable cost is 30,000, sales is 50,000 and desired profit is 5,000. So the formula you have to use here is desired sales is equal to fixed cost plus desired profit divided by PVR. Same, your break-even formula, whatever is there, you are adding one more component to that, which is desired profit. So 10,000 is your fixed cost, desired profit is 5,000, and PVR you have to calculate. PVR is 40%. Contribution is 20 divided by sales 50. 40%, 37,500. So option is the correct answer. Fifth one. For the coming year, a manufacturing company has budgeted as under. Contribution sales ratio means PVR is 45%. Margin of safety ratio is 33.12%. Fixed cost is 5.85 lakh. Determine profit for the coming year. It is not a difficult question. You have to use whatever you know. See, you know S minus V is equal to contribution minus FC is equal to profit. So in this question, only fixed cost is given. Sales is also not given. Variable cost is also not given. Profit you have to find out. So you have to use the formula P over S is equal to margin of safety into PVR. So margin of safety is 33.5% into PVR is 45%. So this you will get 15%. So that means if P over S is equal to 15%, I can write it as P is equal to 15% of sales. Next, you also have contribution minus fixed cost is equal to profit. In this, contribution is what? Your PVR. So PVR is equal to C over S. Therefore, C over S is equal to 45%. Therefore, C is equal to 45% of S. Now you substitute both. What you will get? 45% sales minus fixed cost. Fixed cost is 5,85,000 is equal to P is 15% of sales. So 15% will come on the left side. You have 30% sales is equal to 5.85 lakh. So S is equal to 19,50,000. Now you know profit is 15% of sales. So take 15% of that. So you will get 2.92500. So that is the answer. This is a slightly longer question. You may not be able to solve it in 2 minutes. But don't break your head if you are not able to solve even in 5 minutes. Just choose some option and move ahead. Sixth one, a company has a break-even point when sales are 3.2 lakh and variable cost at that level of sales are 2 lakh. How much would contribution margin increase or decrease if variable expenses are dropped by 30,000? So to solve this, first you have to know at break-even what is the PVR. So sales minus variable cost is contribution, and then you have PVR. Sales is 3.2 lakh, variable cost is 2 lakh, contribution is 1.2 lakh. PVR is 1.2 divided by 3.2 is equal to 37.5%. Next, if there is a decrease in variable expense by 30,000, so this is going to be 3.2 lakh. In variable cost, 30,000 is reduced, so this will become 1.7 lakh. Contribution is 1.5 lakh. So now new PVR is 1.5 by 3.2, 46.875%. So there is a difference of 9.375 and it is increasing. So it's increased by 9.375%. Seventh one, XYZ factory working for 50 hours per week, employs 100 workers on a job work. The standard output is 200 units per gang hour. Standard rate is 1 per hour. During a week in June, 5 employees were paid at 1.2 per hour. 10 employees were paid at 80 paise per hour. Rest were paid at standard hour rate. The actual number of units produced was 10,200. Determine labor cost variance. So labor cost variance formula is SHSR minus AHAR. You have to identify each element. Standard rate is 1 per hour. Standard hour for actual input you will have to calculate. How you will calculate? Here the information is given. Standard output is 200 unit per gang hour. What is the meaning of that? 1 hour 200 unit. How many hours for actual output? So cross multiplication will give you 51 hour you will get. Multiplied by, there are 100 employees. So 100. This is your standard hour. 51 into 100. Into standard rate is 1. So this is on one side. Actual hour into actual rate. Correct. Here the information is given differently. So 5 employees were paid at 1.2. So 5 employees into 50 hour per week into 1.2 plus 10 employees were paid at 80 paise plus remaining means 85 into 50 hour per week into 1. Total AHR is 4,950 and SHSR is 5,100. So 5,100 minus 4,950. 150 favorable. Eighth one. Dash is designed after assessment of the volume of output to be produced during budget period. So after your sales budget, you have production budget. After production budget is your different functional budgets. What are these functional budget? Price budget, material purchase budget, overhead budget. All these are cost budgets. So answer is cost budget. Ninth one. A factory produces two types of articles Y and Z. Article Y takes 8 hours to make and Z takes 16 hours. In a month, 25 days into 8 hours, 600 units of X and 400 units of Z are produced. Given budgeted hours 8,000 per month and men employed are 50. Determine activity ratio, capacity ratio and efficiency ratio. So you should remember these formulas. Provided you remember the formula, then while solving, you have to identify and calculate any one of the ratio. So let's take, so first one is activity, second one is capacity, third is efficiency. So third one is efficiency ratio. So let's calculate efficiency ratio. Efficiency ratio is given by formula standard hour divided by actual hour. What is the standard hour? Or you can also calculate, because standard hour calculation takes time. Instead of that, you can also calculate actual hours. So actual hours is 25 day into 8 into 50. So 11,200. Next, budgeted hour is anyway given 8,000 hours. Okay, now actual hour and budgeted hour is given in which ratio? It's given in capacity ratio. So capacity ratio is actual hour by budgeted hour, means 11,200 divided by 800, so 8,000. So 1.4 means 140%. So that means it has to be either A or C. Okay, so these two are not there. Now B capacity ratio is 112%. So this is capacity ratio. 1.4 is there in option A and C. So that means you have to calculate one more ratio. That means you'll have to calculate standard hour. Standard hour is calculated by how X, no, X is not there. It is Y and Z. So Y and Z takes 8 hour per unit, 16 hour per unit. So for 600 unit, that means you'll have to multiply, and 400 unit. So 8 6 are 4,800, 16 4s are 6,400, 11,200. Efficiency ratio is standard hour by actual hour. Or you can also calculate your activity ratio. Activity ratio is standard hour by budgeted hour. So activity ratio is standard hour by budgeted hour. Standard hour you just calculated 11,200 and budgeted hour is 8,000. So same, this is also 1.4. So 140. It is available in option C. Next question. According to Kaplan and Norton, which balance scorecard perspective serves as a focus of other perspective? D. This is you already solved. There are three departments, A, B, and C in a company. The sales of A, B, C are 352, 288, and 160. The variable cost of ABC are 2.4, 1.76, 1.44. Direct fixed cost are 28, 22, 12.8. Rank the different department on basis of relative profitability. This is a marginal costing table. Your relative profitability is your P over S. So you have A, B, C. Sales minus variable cost. You don't have to calculate contribution here. Minus fixed cost, you will get profit. So sales of this is 352 minus 240 minus 28. Second for B, it is 288 minus 176 minus 22.4. Then for C, it is 160 minus 144 minus 12.8. So in three cases, you will get profit. Then take profit over sales, you get some percentage, and based on that percentage, you'll have to rank. So these are your profits, 84, 89.6 and 3.2. Now you calculate your percentage, P over S. So these are your P over S. So now first rank is your B, second rank is your A, and third rank is your C. So answer you have to search 213. 213. So option B. 12th one. The sequence of possible managerial decision and their expected outcome under each set of circumstances can be represented and analyzed by using. So this is part of your decision tree problem. In decision tree, you have square boxes which are for decision. You have expected outcome which are circles. So if you know, you know. Decision tree. 13th one. Details of fixed overhead, production hours and production for a period are given. Budgeted hour 10,000 hours. Then standard fixed overhead per hour is 10. Standard hours per unit of output is 5 hours. Actual production is 1,920 units. Actual fixed overhead is 94,000. Okay. Now what you have to calculate? Fixed overhead cost variance. Fixed overhead cost variance is the top one. The overall fixed cost variance. This is nothing but your absorbed overhead minus actual overhead. Actual is directly given. So 94,000 is actual. Then absorbed overhead is given by SHSR. SR is given 5 hours. sorry, SR is 10 per hour. So SH you will have to calculate. In all these problems, SH you have to calculate for the actual production. So how do you calculate? 1 unit takes 5 hours. So 1920 units takes how many hours? So this is your standard hours. 9600. So 96,000 minus 94,000. So is equal to plus 2000. Means 2000 favorable. Next, question 14. Division P transfers its output to Q at variable cost. Once a year, P charges a fixed fee to Q, representing an allowance for P's fixed cost. This type of transfer pricing system is commonly known as. Again, if you know, you know. It's a two-part tariff system. Two-part has your marginal cost plus a part of your fixed cost. Then last one. Production budget is based on all of the above. Correct. Production budget is depending on all. Okay, next set. First question. Which of the following is not typically part of management accounting? Not part of MA. Answer is C. Because financial statement, external reporting. This is done by financial accounting, not by management accounting. Second one. What role do management accountants play in evaluating the impact of external changes on the business? Impact of external changes. So correct option is A. Designing marketing strategies done by marketing department. Employee benefit is done by HR. Managing customer relationship is done by sales or custom relationship manager. So these are all eliminated. Correct answer is A. Third one. Activity based cost system would probably provide greatest benefit for the organization that use job order costing repeated. In activity based costing, A, non-manufacturing cost may not be assigned to product. Some manufacturing cost may be excluded from product. Allocation bases are same as those used in traditional costing method. Similar to traditional costing, ABC only uses one overhead cost pool. D is confusing, but it is the wrong answer because it uses only one overhead cost pool. So that's a wrong statement. If they have given ABC uses overhead cost pool, then it could have been correct answer. So this is eliminated. Non-manufacturing cost may not be assigned to product is also eliminated. Reason? If the activity is selling, if the activity is purchase order placing, then it is included in ABC. So A is eliminated. C, allocation bases are same. Directly you can eliminate. Allocation bases are depending on your activity rates. So remaining is B. Let's see what is it. Some manufacturing cost may be excluded from product cost. This is correct. If that activity is not there in the manufacturing of the product, that manufacturing cost is not included. Fifth one. In a purely competitive market, 10,000 pocket transistors can be manufactured and sold and a certain profit is generated. It is estimated that 2.0 pocket transistors needed to be manufactured and sold in a monopoly market to earn the same profit. Profit under both conditions is targeted at 2 lakh. The variable cost per transistor is 100. Fixed cost is 37,000. Unit selling price per transistor under monopoly condition will be. So competitive market means there is a cap on the sales demand because other competitors also selling. So 10,000 pocket transistors can be manufactured and your selling price is capped because the competitor sells for lower, you have to match. In a monopoly market, there is no competition. Whatever you set the selling price, that is the selling price. So they are asking selling price per transistor under monopoly condition. So this can be, I think, 2000 only. 10,000 and 2 does not make sense. So you have to go from below your statement of marginal cost. Sales minus variable cost, contribution minus fixed cost, you get profit. So total profit is 2 lakh and your fixed cost is 37,000. That means your contribution is 2,37,000. So variable cost is 2000 into 100 is 2 lakh. So total selling is 4 lakh 37 divided by 2000. So D 218.5. So answer is D 218.5. Next, a firm has given the following data. Fixed expense at 50% is 15,000. Fixed expense when factory is closed down is 10,000. Additional expense in closing down is 1,000. Production at 50% capacity is 5,000 units. Contribution per unit is 1. Advise whether to run the factory or close it down. So here the question is, you don't have to calculate anything. If there is a contribution, that means you continue production, means you run. So run the factory. So again, run and continue may be same meaning. So they have to clarify what is the meaning of continue or run. Since the question is saying advise whether to run the factory or close it down, so you have to only decide between these two. So run is the correct answer. Seventh one. Minimax Limited fixes interdivisional transfer price question for its product on the basis of a cost plus a return on investment in division. The budget for division X for 22-23 appears as under: fixed asset, current asset, debtors. Annual fixed cost of the division 8. Variable cost per unit of product 10. Budgeted volume 4 lakh units per year. Desired ROI 28%. Transfer price of the division. So cost plus is asked. That means variable cost plus fixed cost plus ROI of 28% on assets divided by 4 lakh units. Variable cost is 40 lakh. Fixed cost is 8 lakh. ROI is on these 3, 8 plus 5, 15 plus 2, 15 lakh into 28%, 4.2 lakh. So total is 52.2 lakh divided by 4 lakh units. So option A 13.05 is the answer. Next one. Standard cost card contains quantity and cost for whatever you have learned in standard cost. All variances. Material, labor, overhead variances. Ninth one. In producing product ZZ, 14,800 direct labor hours were used at a rate of 8.2 per hour. The standard was 15,000 hours at 8 per hour. Based on these data, the direct labor. So they have not asked the variance. They have given the variances in the option. So you have to calculate both quantity and price variance and select the correct answer. So labor rate variance is given by SR minus AR into AH. Then next one is labor quantity variance, or it is called as labor efficiency variance, is given by SH minus AH divided by into SR. So when you get these two data, one of them will be matching the 4 options. So labor rate variance you got minus 2960, efficiency variance you got plus 1600. Out of these options, quantity is efficiency, price is rate. So this is not, these are all not matching. I mean this, so option C. Okay, next one. A company expects to sell 50,000 units at 20 each. The variable cost per unit is 12. Fixed cost is 1.8 lakh. What is company's budgeted profit? Straightforward question. So answer is 2.2 lakh. Option B. 11th one. Dash is the first step of budgetary system and all other budgets depend on it. Sales budget. 12th one. At the start of the year, a division has non-current asset of 4 million and makes no additions or disposal during the year. Depreciation is charged at a rate of 10% per annum on all non-current assets held at the end of the year. Working capital is 0.5 million at the start of the year. All through this is expected to increase by 20% by the end of the year. The budgeted profit of the division after depreciation is 1.2 million. What is the expected ROI of the division for the year based on average capital employed? So ROI is given by what? Return on investment. Here investment is your capital employed, but you have to compute on average capital employed. So return is given 1.2. Then investment, you have to take the average. First you have 4 million non-current asset. Then there is a depreciation of 10%. That means at the end of the year it is 3.6. So for 3.6, the average becomes 3.8. 3.8. Then you have working capital 0.5 million at the start of the year and expected to increase by 20%. That means working capital is 0.5. It goes to 0.6, 20% more. So average is 0.55 plus 0.55. So this is equal to 1.2 divided by 4.35. 27.58. So option D. The characteristics of a responsibility system for a JIT or lean organization. JIT means just in time. Means there is no inventory holding. Whenever a production happens, the inventory should come. So that is JIT. So among the four options, which is the characteristics of a responsibility system for a JIT? You have to think logically for this. If JIT has to work, all the systems should work coherently. Means together. That means purchase order system should be on time, production should happen on time, the logistics should happen on time. So when such system should work, independence of subsystem is not permitted. So that is eliminated. Then system should not also compete. So if A and B are taken out, D is also taken out. So cross-functional measurement means everyone has to work together. So C is the correct option. 14th one. The most elementary form of responsibility center is, means the most basic form of responsibility center. The most elementary form of responsibility center is cost center. The reason is there can be company without any revenue, but every company will have cost. So if there is a startup, they don't have any sales, but they have expenses. So cost centers are there. So basic is cost center. A company is choosing which of the three new products to make, A, B or C, and has calculated likely payoff under three possible scenario 1 to 3, giving the following payoff table. Using Maximax, which product would be chosen? Maximax means what? Maximum, and then take next maximum of them. So first we will take maximum of each scenario. So in scenario 1, 80 is the maximum. Scenario 2, 100 is the maximum. Then scenario 3, 50 is the maximum. Out of this, which is the maximum again? Now we have done Maximax is 100. 100 is coming in which product? It's coming in product C. So correct answer is C. When Maximax is given, just take in the table whichever is the maximum and take that product. You don't have to do all this calculation. If they have given Maximin or Minimax, then you'll have to do all of this. If it is Maximax, directly you can take in the table whichever is the maximum, take that. So that's all for today's MCQ. We will continue in another session. We will take the previous year question paper.